G'day guys, it's Ben and Simon. Welcome to another episode of the Pumped On Property Show. Now, if you're watching this, Simon and I are lying on a daybed or sitting on a daybed right now, so there's going to be a fair bit of swinging.
I'll tell you what, I wish it was summertime. We're just kicking back here, but it is a little bit colder this morning.
It's cold as this morning up here.
We were just sort of filming a video behind the fire and it's like going on and off and we're like, oh, people are going to give a shit because we don't know how to light a fire. We know property, not how to survive in the bush.
Survival skills are zero, but I've watched a lot of Bear Grylls. Nah, all jokes aside, I do actually know how to make a sick fire. I just wanted a little one for those videos that we're just recording at the back, just enough for the kids to do a marshmallow one.
Yeah, we didn't want our backs to singe on fire. But no, really looking forward to chatting about today's conversation because I've been talking to a hell of a lot of new investors recently, and a lot of the consensus that people are talking about is they're getting a bit fearful that the Australian property market's going to collapse, and because people have been talking about this property boom for so long, people are sort of thinking, oh well, when is it going to end? So we thought we'd share some ideas of some of the people that we follow and their beliefs about where we are in the current cycle, and if and when the Australian property market is going to collapse.
When's the real estate market going to collapse over here? Could be any time.
Coming in live from CNN over
here. No, like I think a really good strategy, and it's obviously not mine, is just to be, when things are going really well, just wary, and when things are going really bad, probably don't be as freaked out about them as everyone else is at the time. And I think that rule has served me pretty well for the last 10 years. Like if I had have listened to people when I first got started in 2011, which was, I didn't know because I'd just come out of uni, but the end of the GFC really, and probably like 3 of the worst years in the last 100 financially for the world. People were saying to me at the time, like, why are you buying property? Why would you do that? It sounds like a terrible idea. It's a horrible investment. And I was like completely, I really wasn't watching the TV at that time at all, like, because I was living my life. And so I didn't even really know we were in one. Like I was working a shitty job at a bar or cleaning beds for a living while I was at uni, and I really was able to always find that sort of work even in that market. So I wouldn't have bought then if I listened to other people, and I certainly wouldn't have bought in 2020 if I listened to anyone else.
Yeah.
Even my father-in-law, who's been a builder and a developer for the last 30 years of his career, was like, Ben, do not buy this year. I was hitting him up. I'm like, places that were selling for 500 last year are selling for 350 now on the beaches of Brisbane. And it was this tiny window. And luckily enough, I got to a point by about May where I was like, this is going to turn. And I was able to just get one property. But looking back, you got a couple.
Yeah.
It's just like it was a year that everyone said not to do anything, and
it worked out really well for us. And there's always going to be haters. There's always going to be pessimists, and rightfully so. Like there's got to be two ends of the spectrum. And there's people that have been saying that it's going to collapse for the last 10 years, and some parts of Sydney have doubled over the last 10 years. Some parts of Melbourne have doubled over the last 10 years. Hobart. Some parts in Brisbane City have done really well. Some parts in Perth City have done really well. So, it's just about making smarter decisions and trying to get into those right markets. Like I have this photo on my vision board at work next to my desk, and it's like a quote from Bruce Lee. And once, like I'll paraphrase it, but it's like,
can you rap it?
Definitely not. You heard me before. I'm a one-word rapper. That's about as far as it goes.
I'm just thinking about this swinging, man. If I was watching this on YouTube, it would be the most annoying thing. So I reckon we should stop.
I'll try my best.
I know, like you've got like restless legs all the time.
You're always
like sitting there and like
tap 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 tap
tap dance,
tap it in. But it says along the lines of like, when things are good, receive it fully and understand it's not going to last forever. And when things are bad, just have faith that it's never going to last forever and things will be good again at some point in the future. And I think that's a really cool way to live life. It's just like, you never know what's going to come next. There's no point like holding back your life and your decisions because you're fearful of something that hasn't even happened yet. So
I love that, man.
For us, it's just about trying to like understand what's going on in the economy and what certain political decisions are impacting the way that we make decisions, and understanding the way certain markets have performed and whether or not that represents value moving forward, just to try and err on the side of caution, make smarter decisions, and have that confidence like in your gut moving forward. Because you know, shit's gonna be good, shit's gonna be bad in the future. It's just you gotta still live your life, right?
Yeah, and you know, one of the indicators that I'm following at the moment is what they call the yield curve. So this isn't a secret. A lot of you guys would already understand it. Just Google it if you want to really understand it. But effectively, there's the 10-year bond price, which people buy 10-year bonds at. Now, I personally I'm not wealthy enough to be looking for a 2% return and to be happy with that. But, you know, there's obviously a lot of big money, royal money, old money, drug money. I don't know who's buying this stuff, but it's like there's money out there that likes the 10-year bond. And then there is the 12-month or 3-month or 6-month bond rate. Now, the yield curve is effectively the difference between the short-term and the long-term bond rate. And historically, when there is an inversion, which is a place where those two lines cut each other off, normally for at least the last 30 years or even longer than that, every single time they've cut each other off, within 9 months there's been a recession. Could be a mid-cycle slowdown, an out-of-cycle recession, or like a GFC or Great Depression.
Yeah.
Now, in 2019, the yield curve inverted.
Yep.
Everyone was aware of it. Even Ray Dalio and Warren Buffett came out in Bloomberg and was like, warning sign, guys, there's going to be a recession. No one listened to it. The markets went crazy, even though those guys were in cash. And then what's happened recently is like it's gone back from being inverted and completely separated itself again. So that is one indicator that you can follow so easily, and get a bit of an idea about where we're at. And there's so much data to support that being one of the indicators that we look for. So that's a positive. Another positive at the moment in the economy, which is why I don't think we're going to have an imminent collapse, but at any time we can. And so it's just remembering that at any time, history can completely change itself. Wars change cycles, people change cycles, technology changes cycles sometimes. So anything can happen. But another thing that I'm noticing at the moment is governments around the world are still buying massive, massive amounts of long-term bonds. There's inflation, if not hyperinflation, inflation coming very, very soon. You know, governments are still printing money, dropping helicopter money. They're still investing in infrastructure on a scale that we've never seen before. Commodity prices are super high. A lot of agricultural prices are still high. The world is still trading around the world in many markets. The unemployment rates are declining. Many markets in the world have an undersupply of property, which they always will by this time of the cycle.
Yeah.
So there's a lot of good stuff happening if you just look at the macro economy.
Interest rates being super low as well, making it a little bit more affordable to hold real estate. You know, they're talking in the States at some point this year to increase those interest rates, and same in Australia at the end of 2022. They're looking at increasing them, but it's only going to be very gradual. It's not like they're going to go, boom, back up to 8%, guys, good luck. It'll be obviously a nice gradual increase like it was a gradual decrease. So, you know, that gives you a little bit more confidence that you've got some time at the lower interest rates to set things up and put yourself into a bit of safer position. There's also lots of, you know, different analysts out there as well, and economists like Phil Anderson, Fred Harrison. I know we beat those guys to death all the time and talk about them so much, but, you know, they've been on point for hundreds of years. So understanding their information is really important to kind of help make better decisions.
How old are these guys?
Well, the research that they've done, I was thinking that, I'm like, hundreds of years. Geez, these guys must be
This
vampires.
guy's like 300 years old. This guy.
But they've done like research, obviously, because we've been tracking the stock market and the property market for hundreds of years in Europe and the States now.
Sure. I mean, we were talking before about whether we should just let like some of these things roll or whether we should like cut them and edit them. And it's like the stock markets are only like recent, like in the last 100 years, you know?
Yeah.
So we haven't been tracking the stock markets for hundreds of years. But money has been moving around the world, or sticks have been moving around the world, or gold for hundreds of years.
Something, yeah, fiat currencies.
But yes, these guys live for hundreds of years, and this stock market is at least 1,000 years old. We're not going to edit this shit anymore, guys. I hope you don't mind us having a laugh, because like Simon's constantly saying stuff to me, and I'm constantly saying shit to him. Like, hey man, like that wasn't 100% on. And I know that half of you guys are like me, and you're like, that guy just fucking said something that wasn't true. And it's like, you're looking for that crack,
that tiny
in
little
the Michelangelo to like figure out the hole, to like not trust them. Because
Hey, nobody's perfect.
But yeah,
especially.
like what I love about what you just said is, you know, these guys have looked at 250 years in America, 350 years of European history, and based on that history, we are in a very, very good part of the cycle now. So we've gone through the first stage after the GFC of positive upward growth, which stock markets and property markets around the world benefited from. We've just gone through the pause, the mid-cycle slowdown point. Now what happens historically based on their research, which is much better than ours, is, you know, normally about a pretty bloody good run from between now and about 2024, 2026 even. So it's definitely a time where there's a big expectation in markets for prices to go up. You know, Commonwealth Bank, Macquarie Bank, CoreLogic, SQM are all expecting prices in many of Australia's capital cities to continue to grow in the next couple of years. The forecast from the Fred Harrisons and the Phil Andersons is we're nowhere near a collapse. In fact, we're actually setting up for one of the most positive wealth creation runs in history.
And like it definitely makes sense when you think about all of the money that's been created over the last 12 months around the world, and that's got to filter through the economy somehow. Like that money doesn't just become available and then disappear. Like once money is created, even if it's created out of nowhere, it's still going to run through the economy one way or the other. And with all of this helicopter cash as well, it gets people out and spending money, and you know, it's filtering through the economy. And what Phil talks about a hell of a lot is that the economic rent, which is like all of the gains in society end up back in the land values one way or another over the longer term. And it's really, really interesting, especially when you think about like how much money is being spent on renovations at the moment and things like that. It's like, let's go out there and upgrade our home. And when you're doing that, you're obviously adding value to your home. You're paying these tradespeople, you know, to work on your home, which is increasing their incomes, and then they're going out there and upgrading their homes or buying investment properties or something like that. So it all, you know, it's a big moving machine. And with all of that money out there at the moment, it just makes it hard for me to think that there's going to be an imminent crash.
Some of the other things that are supportive of a more blue weather environment. Now, every single year that I've been doing this for the last 5.5 years, there's been horrible news of one way or another that's kept people on the sidelines. COVID last year.
Far out.
Maybe next year to be the thought of interest rates rising.
Well, there was that CoreLogic article that looked at the last 5 years. It was to sort of end of 2020. The last 5 years basically being the lowest performance in Australian real estate for the last 25.
It's crazy. Like, and you know, there's a whole bunch of reasons, but the major reason was the government was getting seriously concerned about Australian bubble in 2017.
Yeah.
But even before that, 2015, and they started to put in, you know, some heavy regulations to stop people borrowing money.
And it did. Like, you know, developers weren't able to get finance, and like a lot of the oversupply of units in Sydney, Melbourne and Brisbane started to get soaked up because they couldn't continue building these things. Like, you know, everyday investors, they struggled to get finance. International investors, they basically just stopped allowing to finance purchases in Australia.
Self-managed super fund purchases, like the investment, the average like long-term percentage of investors in the market, what does it sit at? About 35%. You know, that got as low as like 10 to 12% in some of those years between 16, 17 and 18.
It's still only sitting at 25% as well, and that's after a pretty massive increase over the last month or two.
You know, so one of the things that I think we've got to be aware of is the media cycle works off bust and boom and nothing else sells in between. So it's like a good move in the right direction is good, and then they replace it with fear, because fear and excitement feel very similar in the body. It's still just the same chemical release, and then excitement turns into fear. So that 2019 bull run in the American stock market turned into an absolute panic, which saw the stock market over there drop by 50% last year. And these things happen, and you've got to remember that the same people that are having a punt in crypto right now, you know, the average punter, the person at your gym, the hairdresser, the baker, is the exact same investor next to you in the stock market and the property market. So crypto is this beautiful example of a 20-year cycle every year.
Yeah.
And you've got to remember that those same emotional people are going to rush into property when property's going good, rush into stocks when stocks are going good, and always artificially kick the can way past where it should be.
Yeah, and after doing research over the last 50 years, there was the article from Homely that we researched, and the crazy thing about the way people make decisions is from performance. Like, people love to back a winner.
Short-term performance, like whatever's done recently well.
Yeah, like, isn't it the likelihood of a market that has just increased by 10% is about 75% likely to increase by 10% the next year?
Yeah,
or
like
higher?
I think it was about 65% that I found out, which is an insanely high probability.
I back it.
Yeah. Well, Brisbane's just had its first 10% growth year in the last 12 or 13, so that's one positive indicator there. But for those of you sitting on this about like, should I not, we've got no idea and we never will. But, you know, there's some very, 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 very positive stuff starting to come out now. And I think, you know, what comes next after this like really positive run where stock markets, you know, property markets in Australia and in other parts of the world will do well. And we're not talking about maybe like Sydney might not do as well as like Brisbane, or it may, we don't know. It's just like the markets that have done really well generally don't do as well in the second half.
And doing nothing is obviously not going to help your situation if you want to become financially free. You know, it's super difficult, if not impossible, to save your way to financial freedom. So what we do to avoid being as fearful of the future is creating a long-term investment strategy. You know, ideally 20 years plus. I don't ever want to sell any of the properties that I've bought unless I've strategically purchased it to sell it at some point in time. So having a longer term outlook, because if you look at the long-term performance of real estate in Australia, it's been insane. What were you saying? That somebody was looking at the 100 years, it was
John
11.
Lindemann.
Yeah, 100%. I mean, 11% per annum over the last 100 years, insane. Then you look at 50 years, Sydney, Melbourne, Brisbane doing over 9.5%. Over the last 20 years, Brisbane, Sydney, Melbourne and Perth all going by over 6.5%. So like the longer term trajectory always looks quite positive. So if you have that longer term outlook, then it might make it a bit easier to weather the storms when they come.
You know, I was every Sunday, like, or just recently again, since we've moved, a few of my mates come around. We do we normally just do like a stretch, then a little workout. We do the Wim Hof breathing, cold pool, and then just end up having like a chat in the spa. And we do it for about a couple of hours. And we're sitting in the spa this week, or the last week that just passed, and one of my mates, and he's doing really well, like him and his partner would be earning well over 300 grand a year combined. He's like a manager in the pharmaceutical space, said to me, you know, we're talking about goals and stuff, and he's like, yeah, man, your appetite for risk is much higher than all of ours. And I'm like, because all of the guys train, I was like, it's not that my appetite for risk is higher, it's I've conditioned myself, like you break muscles, I've conditioned my fear response to not be the thing that drives my decision making. I actually think I've got a lower risk profile than every single one of my friends, but I don't have a risk profile that is driven by emotion or fear.
Exactly.
And maybe that's because I think I might be slightly autistic and like somewhere on the spectrum, and it's like, you know, we're all there somewhere, but I'm like, yeah, maybe like numbers for me are a little bit like, you know,
well, you're always going to dot the I's and cross the T's before you make any decision. And I think that definitely helps because it immediately pulls out the emotion.
But you know what I think I wanted to get to there with what he was saying to me is just, you don't have to invest with fear.
No.
And you don't have to completely know every single thing about investing to invest well either. Like, I think I look at the markets constantly. Like, I just can't help it. Whether I was recording these videos or not, this is the exact same habit that I've had for 10 years. I've just been constantly absorbing information to help me make a decision. What I'm always looking for is that canary in the coal mine that's telling me it's bad early or it's good early. And people are really, really, really fucking good at looking for the bad one and really bad at getting early on the good change. And so, like, I remember Ray Dalio, and we are just looking at some videos this morning from one of the big share trader guys. It was a video from Dalio in early 2020 where he's like, this is the worst thing since the Depression. And that video did really well, like 1 million views. And then the next video that came out a month later around that saying Ray Dalio has just retracted his entire position, got printed nowhere, got shared nowhere, and had like 15,000 views on it when the other one had 1 million.
You only hear what you want to hear, eh?
And so he said, in like legitimately, like I think it was April, it was just after we got back from holidays, that because of the way that the government's stepping in globally, it's unprecedented money support, financial stimulus. This is over. Yeah. We've just got to wait. And I went, if Ray Dalio, the most successful investor of all time, has said this, why isn't everyone just immediately moving their position? But it's taken up until now for most people to feel confident.
And maybe it's because most people get their information from mainstream media as opposed to like going down the rabbit hole and finding these little ones. Like, you know, we talk about Phil. How hard is it to find his information out there? How hard is it to find his book and buy his book or find his YouTube videos?
His book,
It's so hard. It's like people don't want you to find this information, but when you do, it's a blessing. There's no doubt about that.
So this risk profile thing, I think you've got to make a decision internally to go, I'm going to bury my head in the sand and at the wrong times of every market come in when everyone else has already done well and grab something because it feels safe. Or I'm going to become the sort of investor that Simon and I logically make decisions based on benchmarks and posts at certain times of the cycle to try and do a little bit better than the average, and not to do a bit better, to protect your downside at the worst times. And I think when my friend said that, like, I didn't say too much about it because there was like 6 of the boys there and I didn't really want to go into it. But it's like, risk only feels like risk when you don't understand what you're focusing on.
Yeah.
Now, all I've been doing, if you look at the Warren Buffett thing, where when you walk into his office, apparently there's a book that he read, which he loved, the baseball book, where it's like, you know, the best batsmen in the world and the batters that have like a higher average. I don't know the language, I'm so bad. I'll be getting hammered for this, but whatever.
Don't worry, there's probably not too many baseball players watching this one right now.
It's like you only swing at things within like your controlled environment that you've got a better chance of hitting. And so the difference between like a really, really, really good batsman and a really average batsman was just what they would swing at.
Yeah.
And so Warren Buffett, you hear him all the time. He's like, I missed Google, I missed Amazon, I missed Tesla at the start, I missed crypto at the start. You know, I don't understand it and I'm not going to touch it till I do. So I really, really, really recommend, like, the only way to get successful and to get comfortable, and you're never going to be comfortable, by the way, you're always going to feel sick when you buy if you actually give a shit about yourself and your family's future, is figure out what you're prepared to swing at. For me and Simon, it's just property.
Just residential property as well. Like,
just resi property.
You know, we don't look at other things, and, you know, we've done differently. Like when you started 10 years ago, you know, you might have been able to knock one out of the park, but you did because you stuck to what you knew and you focused on the one thing and you became a specialist in that. And that's what I'm working on at the moment as well. And it's coming and starting to pay its dividends finally now, which is awesome. But you don't need to, you know, this idea of diversity being the only way to like avoid risk is just a bit crazy in my opinion.
I love Buffett's quote. He's like, diversity is for people that don't know what they're doing. It's like all of my properties in Brisbane are within legitimately one of 2 pockets.
Yeah, seriously.
And it's just like, it's because why would you buy Penrith or why would you buy deep northwest Melbourne when you could buy St Kilda or Cronulla Beach or Manly Beach now? And it's like, you can do that here for 600k still or 450k still. Like, go all in of what's worked in the past in these other bigger cities.
Yeah, so I don't know. I like the look of where we're at. So does Ben at this point in the cycle. But that's our opinion. You know, take it with a grain of salt. You know, within the next decade, certainly things are probably going to get really shaky. So you just want to obviously prepare for that and have your contingency plan and understand when might be a good time to buy another property or leverage a little bit forward, or when might be a good time to sell off some assets or change the way that you're holding them, maybe from negatively geared to positively geared, or, you know, upgrading the portfolio in one way or another, because you still got to be conservative and you still don't want to become unstuck when things do come to a close. And, you know, there's sort of Phil's talking 2026, 2027 for the big collapse. Only time's going to tell with how that plays out. And we'll just continue putting out podcasts like this. Benny will get Phil back on the podcast within the next 6 months, and we'll be able to get a real-time update as to where he thinks we're at and where he thinks the top's going to be as well.
The most important piece of information that Simon and I have ever been lucky enough to find that is absolutely worth writing down or remembering is, based on the past 13 mid-cycle slowdowns, property prices have only ever dropped globally by up to 10%. In most markets, they actually sit flat. Sorry, that's not getting edited out either. And in a lot of markets, prices go up with property. Now, in stock markets, historically, they've dropped by as much as 40, 50% even, but they've always come back to their previous point within between 9 months and 18 months. So that is the mid-cycle, which we've just gone through.
Yeah, we're obviously here now.
So next time this happens, don't freak the hell out. Like, just recognise it and decide what type of investor you are with your financial advisor and accountant to make the most of it. The difference between mid-cycle and end of cycle, and as we get closer to the end of cycle, please remember this, things get much worse. This is when governments, because they're in so much debt now, can't get into any more debt. It's when banks around the world aren't willing to be as kind as they were in the thing that we've just gone through, where they freeze your holidays.
Yeah.
They'll just foreclose your property, and they don't have the government backing to bail themselves out.
Yeah.
This is when banks go under. This is when governments go bankrupt. Like, this is how bad shit can get. The average in the last 13 or so cycles has been a 38% drop in property prices in a GFC or a Great Depression end of cycle event. And stock markets on average have dropped between 50 and 65% during that time, even as much as 70% before. So
and it lasts a lot longer. The mid-cycle is typically, 6 to 18 months, where end of cycle is more 2 to 4 years.
So it's one of those things where you address both things differently, but you proceed with caution leading up to them. And that's when you want to have stability, safety, good cash in the bank. And if you are an active investor like we are, it's a once a decade opportunity to take advantage of the market and grab things cheap.
And some of the things that happen when things are getting a bit bubbly or a bit close to the top, and all you got to look back to is 2019 stock market. Every man and his dog was talking about it. Every single one of my friends that knew nothing about trading the stock market was talking about getting into trading. And, you know, a lot of them got burnt, but fortunately it was just small amounts of money for them.
And it's only short-term burn. If they're holding for 20 years in the index, they'll be absolutely sweet. It's just like, it sucks to lose 50% in your first year.
Yeah. And then, you know, you get to the end of a cycle, which is called the winner's curse, and everybody is going to be talking about all assets at that point in time.
Stocks, crypto, businesses, speculative. People will be buying commodities, gold.
Yeah,
everything.
Yeah, there probably won't be anybody on the sidelines. Now, right now, there's still a lot of people on the sidelines, a lot of cash on the sidelines, but come top of the cycle, a lot of people are in. And the unfortunate thing is, in these circumstances, it's more often than not the mums and dads, the punters, the everyday investors that get the most burnt. And, you know, the banks, the governments, even though they don't necessarily step in to help, they'll get bailed out. And you'd look back to the GFC for that. You watch The Big Short and you watch what happens at the end. Nobody went to jail, or like one guy went to jail.
It's a really good thing to know now. You know, whether the next thing comes through in 3 years, 4 years, 6 years or 7, whatever it's going to be, you know, every 7 to 10 years, for as long as we can remember as humans, we just can't help but speculate. We can't help but want to chase quick, easy, cheap, dirty money
Well,
as quickly as we can.
You've been sitting on the sidelines for so long, everybody's like, I want to get in now.
Finally, it's taken me 10 years to get past the last one. And then we just had this like midpoint where it's like, oh, that's a bit scary. It felt a bit like the GFC again. I'll just wait 3-4 years for everything to feel more comfortable. And a lot of people have been out for 14 years. It's like forgotten about the burn and then go touch the fire again at the wrong time. And so we want to protect you based on this history. Now, we want the best for you. Like, we want you to understand this stuff. Whether these dates that we're getting from Phil, Fred, Ray are correct or not is irrelevant. What matters is that there are good times and bad times, and you need to take advantage of them in, equal measure at the right times for you.
Yeah, in your own way. I think that's the most important thing. Now, I think the best thing to do is, go have a meeting, have a sit-down meeting with your accountant or your mortgage broker or your financial advisor and look at where you're at right now and where you want to be in 5 years, 10 years, 15, 20 years in the future, and start to develop that plan and start to figure out your risk profile so that you can safely move forward. And if property is the avenue that you choose or that you feel a little bit more aligned with or passionate about, then we do work as buyer's agents and help a very small number of people invest in the Southeast Queensland real estate market. Now, if you want to learn a little bit more about what we do and how we do it, then you can just head over to our website, pumpedonproperty.com, and follow the links to lock in a free strategy session where me, Ben, or one of our colleagues will have a discussion with you about where you're at and where you're looking to be, and we can educate you a little bit more on the Australian and Southeast Queensland real estate markets and help you get a little bit more confidence or clarity around where things are at the moment and what you might want to do next.
For sure. As an investor, we really like simple things. Good locations, big land sizes, quality suburbs, quiet streets.
Stock standard, just fundamentals.
The stuff that I want to live in for the next 30 years while I raise my kids. Good schools, good infrastructure, good jobs, good transport, great lifestyles. And so I don't think it's rocket science. When I first started out, there was so much to it that was overwhelming. But as I've walked further and further, and that's what we really help our clients do, to simplify this stuff to the point where it's comfortable and easy to make a decision after you've got 4 to 6 weeks worth of market information, so that it is no longer overwhelming like it is for my friend sitting in the spa, but it feels, I've got this, I know why, I know how it's going to connect to my long term. I can take that to my advisors, my accountants, my financial people, and factor that into your overall plan, and then we can just support and facilitate you to get into the market in the right areas and execute the strategy, as Simon said. Yeah,
no, it's really exciting, and I'm excited to see what happens over the next 5 to 10 years, and whatever happens will happen.
It's gonna happen anyway.
Yeah, exactly. So hopefully you can learn a little bit more, read different, get some information from different resources like Ray Dalio or Warren Buffett or Fred Harrison or Phil Anderson or Catherine Cashmore, CBA, any of these more reputable sources, I guess, and go out there and make the most educated decision based on where you're personally at the moment, and hopefully get out there and invest safely and confidently. Oh, sweaty, so sweaty.